Appreciate everybody hopping on here today. I know some of you might have watched my last presentation about 2 weeks ago. I'm recovered from COVID. It was COVID, kicked my butt. But for anybody who happened to miss my last presentation, it's called Fangify. It's posted in the real estate group here. I'll do a quick intro on me. My name's Nick. I'm 31 years old, graduated from USC undergrad. I've had a career for the last 12, 15 years in sales. Most recently, I run direct-to-consumer sales and merchandising for Oculus. Currently married to a beautiful woman, way smarter than I am. And the crux of the situation is that I am financially free through real estate investing. Please, as you come in here, mute yourselves, put any questions you have in the chat. We'll get to those. We're also going to have a Q&A here at the end. So let me go to the next slide here. There we go. Today, we're going to cover why creative finance is important and how you can utilize some of the tools we're going to talk about here. We're not going to go particularly deep into any of them because you're going to see there are tons and tons of different options out there. I should talk for about 30 minutes. I'll talk about these tools a little bit. I'll give you some example deals that I've done with real numbers. At that point, I'll open it up for Q&A. Apologies in advance if you hear dogs barking. They like to hang out here in my office, so I'll try and keep them quiet, but they're golden retrievers and have minds of their own. And don't worry if you have to drop off the presentation, if you missed some, we're going to be recording it. And I'm actually going to post this presentation as well. So if anybody wants to go a little bit deeper, they can do that. So I have never been the smartest or the richest person in the room, but I sure as heck try to be the most creative. This has been the key to my scaling. It's allowed me to blow past the 10-unit limit that everyone talks about with Fannie and Freddie. It's allowed me to receive infinite returns on a variety of projects over the years. Hell, in one case, it actually has allowed me to buy 8 A-class single-family homes and take them off somebody's hands for completely free. So, why is creative financing important? People have histories. Not all of us have perfect credit, and using creative financing, you might be able to find ways around credit score limitations. At a certain point, your debt load might be higher than banks are willing to lend on. And finally, you may only have a certain amount of money to invest, and you want to limit how much you actually have locked in any specific deal. I know I sure as heck did, and for all these reasons, I pursued a variety of different strategies. So getting here, these are the tools we're going to talk about. It's a lot, and this is the reason why we are not going particularly deep in any one of them. We can open it up in the Q&A section if you guys have any questions about any of them in particular, but let's get going so that you have just a general understanding of the tools that you can have in your tool belt as you go about your investing career. First is a HELOC. I actually think this is one of the most powerful tools. If you are a homeowner right now, this is one of those tools that's just absolutely incredible. It helps to solve the down payment fund limitations, the previous reason why you look at creative financing, because you're able to tap into the equity of your home. It's often a second mortgage in your home. It can be the first mortgage depending on how you set it up. And you only pay for the outstanding balance on there. And so generally speaking, for the first 10 years or so, it's interest only. And you can use this account essentially as down payment money for properties, or to be able to go out there and buy properties cash if you have enough in that HELOC. If you have enough equity in your home, I highly recommend you take a look. This is some of the cheapest money that you can get out there. And we're going to talk about other opportunities that are significantly more expensive. This is by far one of the best and something I regularly use myself. One of the other really creative and good ways of getting around some of these issues that we've talked about is a DSCR. This is essentially a loan that helps you get around the credit score and DTI limitations that we talked about previously. Some banks you're going to have to call around are willing to lend based on the income of the asset instead of the value of the home. So most homes are based on two things: the value of the home and what the comps are for that home, and the income that the buyer has. This is a little bit different than DSCR loan. Generally speaking, these are commercial loans, but not necessarily. And what they take into account is the net income as divided by the mortgage or the denominator. When I talk about that net income, what I'm generally talking about there is the rent minus the property management, taxes, insurance, repairs, capital expenditures, vacancy, basically everything before the mortgage. And so if the bank sees that you have a 1.2 or 1.25 or higher on a DSCR, they may be willing to give you a loan that doesn't actually take your personal income into account. It only takes the actual income of the property. So like I said, great way to get around some of those credit score and DTI limitations. And like I said, we can circle back to any of these during the Q&A section if you guys want to expand on any of this. The next one here is seller financing. This has been probably the most important creative financing tool that I have used in my time investing in real estate. This helps solve literally all three of the issues we talked about previously: credit score, DTI, and payment fund limitations. The sky's the limit with seller financing. In these situations, the seller actually acts as the bank and is willing to give you the mortgage on the property. There really are no rules in these situations, and whatever creative idea you come up with is what's possible. Like I said, the seller's bank. I've done 5 of these over the course of my investing career on a variety of different properties, and each one was very different. I'm going to give you an example in a minute of one of these structures that I did. The last one here before I get into an example property is the BRRRR strategy. I'm sure some of you have heard about it. This helps to get around the fund limitations issue that you might come up with. You, in this case, buy, rehab, rent, refinance, and repeat this process over and over again to be able to recycle those down payment funds. So I'm going to give you guys a dumb example because I tried to do as simple public math as humanly possible. You buy a $50,000 house that needs $25,000 worth of work. And when it's all said and done, it's worth $100,000. It rents for about $800 to $1,000. So when you have that $100,000 house, generally speaking, you have to have some level of seasoning. And again, we can talk about ways to get around that in the future. But you wait that 6 months, you go get a loan based on $100,000 down to $75,000, and you have nothing locked in that deal because you were all in for $75,000. You got all your money back out. Really good way to go add value to properties and get your capital back out. That said, you don't need to get all of your money back out for this to be a fantastic solution. Going back to the previous example, if you were to go and needed to put $40,000 instead of $25,000, you still got a $10,000 discount on the house by doing that, because you've essentially built $10,000 worth of equity that you can borrow against. So a lot of people assume you have to get all your money back out for it to be a successful BRRRR. I'm not of that opinion, and generally speaking, this is one of the best strategies for building wealth in real estate. So I want to give you guys an example of a deal I did not that long ago. Actually closed on my refinance on this sucker this morning. So really excited. This is where you get to bring a variety of different strategies together. And you're going to see that what I've done over the course of my career, I'm going to bring you 2 examples here, is combine different creative financing strategies together in order to get deals done. So this was a situation where This was a situation where there were 17 houses in an A-class area called Avon out here in the Indianapolis area. One of the example properties is 5329 Villa Court, if you guys do want to check it out and validate everything I'm saying here. The asking price on these 17 identical homes, they're all identical single-family homes on one block, was $2.4 million. I was looking at that. I couldn't quite justify $2.4 million for the 17 homes. We ended up buying it for $2.193. And the way we did it was pretty creative, if I do say so myself. I brought a partner in. We kept our transactions completely separate. He bought 9 homes and he wanted to buy in cash. Older guy, didn't want any leverage, just wanted to find a really good deal. This was. So we ended up offering $129 a piece for all 17 of the homes. And he bought 9 of them for $1.16 million cash. Now, at this point in time, I couldn't afford to put 25% down on the other 8. And so I went to the seller and I said, all right, I can bring you the buyer to bring $1.16 million cash if you will let me buy the other homes for 1.03, but you seller finance it. You hold the note. You are the bank in this situation at 4% interest rate on a 30-year amortization for 5 years. That was one of the best things I could have done, because each house needed about $8,000 of work in order to get it up to the level I liked it. And I just refinanced them today for $165,000. So I made a significant amount of money on this deal, and they all rent out for $1,500 a piece at this point. And actually, as they're vacating, we're pushing that number up to $1,650. So our returns are just absolutely astronomical. What was really important in this, though, is that I had empathy in the situation. I went in there and I saw there were three parties that needed to be happy in the situation. I needed to be happy. I needed to get a deal that made sense for me. I had a partner that wanted to come buy some amazing homes and get a good price on them. 129 was obviously a really good price if it only needed $8,000 to be worth 165. And then I had a seller that had a problem. Financing 17 homes is extremely difficult. There aren't a lot of people that could do it. And if I was able to come in there, solve his problem, give him more than 50% of what he was looking for in terms of cash payout, and then only have him carry the note for 5 years, he'd be thrilled. So it was a great solution for him that he was able to get out, cash out, and essentially get all the return that he was looking for. I bought this, I believe it was about 16 months ago is when all this happened. And so I just paid him back, what is that, almost 4 years early on that note. So it was a really good deal for him. And actually, I think he's about to come back, given how good an experience he had with me. He's going to come back and invest with me on some future projects. So really excited about this one. Again, we can talk about that more in the Q&A. So one of the other ways that you can use creative financing is through credit partnerships. This helps you really solve the credit and DTI limitation issues that you may have. In this situation, you go out there, if you've got DTI or credit issues, and you say, hey, I've got a great deal. Are you willing to essentially sign on the dotted line? Are you willing to be the one that the bank makes the loan to if you and I work together on this project? It's not something I've done a lot of in my history, but I totally would if the deal made sense. I would rather have 50% of something than 100% of nothing. So it's one of those things to really keep in mind depending on your own personal situation. This is another one I don't have a lot of experience with, although I'm actually buying a deal to do this with the current tenants right now. And a lease option helps to fix the credit, DTI, and down payment limitations that somebody might have. It's kind of like seller financing we talked about previously. The difference being that the seller retains the ownership, at least for a while. The buyer, the lessee, essentially gets the right to purchase the property at a future date at a predetermined price. They generally have a lease in place and are paying monthly, and it's usually above market. And a small portion of that lease ends up going towards the down payment on the property. It's a really cool opportunity for people to buy a home. And it's really great for a lot of landlords if they believe in helping their tenants to get on that property ladder in the long term. Like I said, it's like seller financing. There are very few rules. With that said, I highly recommend speaking with a legal professional just to make sure that your lease is legal. And I would use a property manager or something like that in order to execute this effectively. So I know a lot of people have an IRA and a 401k here at Meta. You might think that it's hard to invest in real estate through there, and you're not necessarily wrong. But there are two ways that you can potentially do it. One is that you can go take a loan against your 401k. You can generally go get a loan up to, I believe it's 50% of your 401k that you could go use as a down payment. So go check it out. It's in the Fidelity app. I actually checked it out just to make sure that I wasn't giving you guys misinformation. I think you can do it here through our own programs. Additionally, if you happen to have an IRA, what you can do is you can transfer it to a custodian who can give you checkbook control. Now, you can't go benefit from this. You can't go, in a lot of cases, buy a second home or a vacation home for yourself out of that. But what you can do is you can go invest in syndications. You can go invest in private money deals. You can even go and flip. Now, generally, it's harder to get a loan on these checkbook controlled IRAs, but it's a really cool opportunity for you to invest in real estate with your retirement money. Here to the next one. Hard money. This helps solve the credit, DTI, and down payment limitations that we talked about previously. Generally speaking, hard money lenders are institutional lenders. That's how they make their money. It's short-term money. It's very expensive. It's cheaper if you have experience in a lot of cases. And generally, it's based on the deal instead of based on your personal income. You'll see interest rates anywhere from 7 to 10. I have on there. You'll actually see on my next deal, I've seen deals as high as 12%, depending on the level of experience, the size of the deal. So it's not for everybody, but it can make sense in a lot of deals. And I'll give you guys an example deal of where it made sense. This was a hard money and BRRRR deal that I did not that long ago. Very repeatable out here in the Indianapolis market. Totally something anybody here can do. It's 6531 East 34th Street. So you guys can look it up if you don't believe what I'm saying. They were asking for $65,000. I had a close relationship with the wholesaler on this one. and got first dibs on it and walked it. And there were some issues with the property that they weren't aware of. So I was able to negotiate them down to $53,000. Down payment on that, when I used a hard money lender, they were willing to loan up to 90% of the price of the home. They wouldn't loan anything on the rehab on this one. So I had to put $5,300 down. The interest rate was 11%. So I ended up paying $1,300 in interest. There was $29,000 of rehab required, so I had to come out of pocket for that. And at the end of the day, I refinanced it. It appraised for $120,000, and I got a $96,000 loan on there. So I literally got a check at closing. I got more than I had invested in the property. There was enough meat on this bone that I could afford to pay that 11%. So I know a lot of people bulk at the 11% I paid, but that was the way I could afford to do this deal. And so it made sense for me. There are other ways. If you happen to have, like we talked about previously, a HELOC could have been a really good solution here, where you might pay 3 or 4% instead of the 11%. So I'm just hoping you guys are seeing that these are all different tools that can fit together in different ways to make a specific deal make sense. Finally, this one is renting out for $9.99 a month. I'm really excited about it. I'm holding it. Don't plan on getting rid of this house for a very long time. Getting into to private money, and again, we're not going particularly deep on any of these, but hoping that you get a general understanding of each of them. So getting into private money, this helps to solve the DTI credit and down payment. These are generally family and friend that you're borrowing from. It's similar to hard money, but generally speaking, these aren't people that their only source of income, their predominant source of income is lending out money. There really are no rules with private money lending. It's based on the relationships you have. They can just loan based on the value of the purchase price. They can do it based on the purchase price plus the rehab. It really is whatever you're able to negotiate with them. With that said, when borrowing from family and friends, this is my own personal opinion, take it for what it's worth. I recommend you wait until you have some experience. I wouldn't do this on your first deal. And the reason I'm saying that is I'm always willing to risk my money on something new, but I'm never willing to risk anyone else's. So make sure you know what you're doing, you have experience, and that you can back it up if something was to go wrong on a project. All right, Fannie and Freddie, FHA. I know you guys are probably saying, oh, this isn't creative at all. I don't necessarily agree with that assessment. The reason I'm saying that is you can use Fannie and Freddie and FHA loans in order to do super low down payment loans, as low as 3% in a lot of cases. Absolutely fantastic option out there, particularly for those who are interested in house hacking. I think that's probably one of the best creative financing hacks you can possibly have. Additionally, FHA loans tend to actually be a little bit easier to get on weird properties. I have an example property that I purchased out here in Indianapolis, actually in Fishers, just north of Indianapolis, that I couldn't get any commercial loan to lend on because it was too big. There's too much acreage. And so I was able to actually get an FHA loan when none of my commercial loans would let me get it. This is all based on your personal qualifications. It's based on your income. So it doesn't help you with the DTI or credit issues. But if you do have down payment limitations, this is a absolutely fantastic product if you're willing to live in the home yourself. Getting here over to subject 2. Again, this isn't something I have a whole lot of experience with, but I do know people that do this all the time. This helps to get around DTI credit and down payment issues. Essentially what happens is you buy the home subject to the existing loan. So for instance, you go to the seller and say, hey, I'll buy this home from you for $100,000. You have an $80,000 loan on it. I'll bridge that gap, pay you $20,000, but we keep that current loan in place. There is insurance out there that can essentially help protect against what is called the due on sale clause. Sometimes a bank will actually call the note due if it is sold. So it's something to watch out for. Like I said, I don't have a ton of experience with it, but I do know a lot of people make a lot of money on this strategy. But there has to be some level of distress. Something has to be causing the person to be willing to do that. Commercial loans. This is one of my favorite strategies. It has completely changed the game for me over the last year and a half or so. I've started partnering with my local bank, and I've been getting commercial loans. For anybody who has gone through the traditional loan process, it is a colonoscopy on steroids. It is terrible. It takes forever. It's uncomfortable. It's awful. Going through a commercial bank is a little bit different. This helps to solve your DTI credit and down payment limitations. Similar to the DSCR loan, there's a lot of flexibility here with commercial loans. It's based on the cash flow of the asset instead of the comps on the property. Similar to the DSCR loans, you can blanket it across multiple properties, which is an absolutely amazing strategy. If you've got multiple properties, you can get a single loan across them just to make your life a whole lot easier. Oftentimes, there's no seasoning on it. With that said, these are more expensive loans. The amortization is often shorter. So where on a traditional home loan, you might get a 30-year fixed, on a commercial loan, it might be 20 or 25 years. With that said, it's significantly easier. For me, I literally just send an email to my loan broker at this point. He schedules an appraisal, and within 2 weeks, we've got a loan done. Really amazing. So the current loans I'm getting are pretty fantastic. This is some of the best I've heard. I know that there are better out there, but just giving you a frame of reference, I'm getting 80% loan to value loans on refinances, no seasoning requirement, 25-year amortization, and 4% for the first 5 years, and then adjustable there on after. So really fantastic loan products out there if you're willing to go the commercial route. And then similar to the commercial loan, there are commercial bridge loans, which actually help you to do the rehab. My current lender will actually loan up to 80% of the cost of the acquisition and the rehab. So really good way of essentially getting money for your deal. It's cheaper than hard money, but generally speaking, takes a little bit longer. For instance, it takes about 45 days to fund one of these. So it better be a big project or something that has a bit of a lead time. Most of the deals that I do, I can't do something like this because I need to close in 14 days or so. So not a good option for every deal, but definitely a great one if you're going to be doing something significantly larger and you want to save on that interest rate. And finally, fundraising. This is something that I'm actually starting to do myself at this point. Similar to private money or partnerships, but with a lot more regulations. You essentially go to your friends, family, and network and say, hey, you guys willing to loan me money to do this project? Or hey, are you willing to be an owner in this company that I'm also an owner in, and work on it together and go do a variety of different projects? You're able to offer an opportunity for return, and then you help to benefit from. You get a much smaller percentage of the total pie, but you can go do something a whole lot bigger. So it's a really good option for getting around especially the fund limitations that you might have. With that in mind, what's next? I covered a lot. If you're just starting out, some of that might have gone over your head. Hell, even if you're experienced, quite a bit of that might have gone over your head. So I hope what you walked away with is that there are a variety of different tools. You don't have to just stick to the traditional 20% down 30-year fixed loans that are out there. There are a variety of different products out there and a variety of different strategies that you can use in order to grow your business. Not every deal makes sense for every one of these tools, but they're all there for you that you can combine and figure out how they can work in a specific deal. So with that in mind, if you guys want to learn more about this kind of stuff, one of the things I'm looking to do here over the next several weeks is I'm going to do a how to get started in long distance real estate investing, how to hire virtual assistants for your business. In addition to, I'm going to be starting up in March here, some coaching programs. So if you guys have any interest in that, please do reach out. And finally, I'm going to open it up for questions from everybody, because I think there are probably going to be some questions. I talked a lot here. I'm sure that there's some contributions that you guys have. And like I said, I'm going to post this presentation for anybody who might be interested. So I'm going to open it up here. Anybody have any questions while I start looking through the comments?
Hey, Nick, it's Chris. I have some questions for you.
Absolutely, man.
Cool. And first, thank you so much. It's been awesome hearing from your experience and expertise, and appreciated the one-to-one communications as well. But one of the things I'm really curious about is on the deal where you brought in the partner on the 17 homes, how do you find your partners if that wasn't like private relationships with friends and family to vet to make sure he didn't go behind your back and just take all 17 or something?
So that one was funny. That's a really good question. This was actually somebody who I just networked with, and I wasn't actually trying to get in on that deal. Funny enough, I had actually negotiated it such that he was going to get the whole deal. I was like, I'll figure out how to make a couple of bucks on this deal if it makes sense. But I had actually negotiated the seller financing for him to get. He was going to put the 1.1 whatever million down. And then he was going to carry the seller financing. His wife at the last minute actually freaked out about carrying the note. And she's like, I just don't want to do it. So then I went back to the seller and renegotiated. I said, all right, here's the deal. He'll buy his part cash. you'll seller finance to me instead. Generally speaking, what I find is, one, network with everybody, talk to everybody, figure out how you can add value. If you guys are football fans, there's a really famous expression, which is just be around the football. I was around the football and I was able to pick up that fumble that like the deal was about to fall apart. And somehow I got 8 houses for free. Yeah, he could have gone around my back. I generally speaking though, just assume the best out of people, and it's worked out for me. And obviously you protect yourself legally wherever you need to, wherever you're exposed, but just be around the football.
Thank you for that. And then the one other follow-up question I had on this is, you talked about offering like seller financing. When you go into deals, I'm guessing it's largely a case by case, but do you have a pretty set playbook of like always going in first for a seller financing, and then if that doesn't work, go to the next? Or how do you decipher whether seller financing is a possibility to offer?
Yeah, so you need to understand how much equity they have. They can't offer seller financing if they don't have any equity. Like they can only offer seller financing on the equity that they have on the property. So with that in mind, that needs to be something you figure out. You need to again, network your way to this information. Try and have empathy the entire time to try and get as much information and understand the pain points. And I don't go in assuming seller financing works on almost any deal. Like I assume in most cases it doesn't work, but I try and understand the situation and figure out which of the creative financing tools actually does make sense. One of the strategies that I like to employ, particularly on MLS deals, is if I can't get information, because a lot of times you can't get in contact with the seller, is I'll make 3 offers on the same house. I'll say, all right, I'll offer you the lowest price cash and I'll close in 2 weeks. And when I say cash, I know I can go raise private money lending to close cash from that perspective. 2, I'll just do a traditional, hey, cheap money, have it be 30 days. And that'll be my middle offer. And then I'll offer them whatever my highest price is at seller finance with a low down payment that I don't have to go and deal with a bank on. So I give them 3 options, and how they answer really gives me a lot of information on what their pain points are.
Awesome. Thank you very much. That's super creative. Give them options so they don't say no. They just pick one, right?
Absolutely. Yeah. And 3 is the magic number. I don't know what it is, but people feel so empowered when they have 3 options in front of them. And a lot of times what ends up happening, just so you're aware, they might like latch onto the price, seller finance, because it's the highest, or they might latch onto the time. And you figure it out. And that's never where we end up at the end of it, but it at least gets them to say, yes, but, versus just no. And the conversation ends. So cool. Toby, see your hand up.
I think actually Chris had his hand up first. So Chris, why don't you go, and then I'll go right after.
Okay. Sorry about that.
Thanks, Toby. Hey, Nick, thanks for your time. Really appreciate you doing this. I'm going to +1 on a question that's popping up in the comments as well. Just more details about the coaching program, like what's, format, duration, how many people, et cetera.
Yeah, it's a really good call out. Let me just share that. I didn't want to seem like I was shilling too much, so I breezed past it. I don't know how to go back anymore. Oh, there we go. Yeah. So this is something I'm particularly passionate about. For those of you who reached out to me after my Fang Defy, I think I've tried to get everybody and their mom to at least book 20 minutes with me, so I can see what I can do to help them out. Two kind of programs. One is the Foundations, is what I'm calling it. It's going to be a 6-month program where I'm going to be helping 6 to 10 starting investors. And again, there could be multiple cohorts. We'll figure it out depending on how many people are interested. I think I've already got 3 or 4 hands raised on that one, so might need to do a couple with group calls twice a month. In addition, that has a very guided curriculum on how to go from no properties out of state to having one property at the end of 6 months. What's really important is that you set a vision, define the strategy, build the team, buy the first property, and just do it the right way versus just buying something and hoping that it makes sense. On top of that, there's going to be one-on-ones and weekly office hours. Very similar on the scale side for people who already have a property or two. I'm going to teach people how I scaled from a couple properties a year to buying 28 last year. And hopefully 40 to 60 this year, and how to put those systems in place. So if anybody has any interest, please reach out. But yeah, it's about 6 months, I think, is about the right amount of time to do it right, given the fact that everybody here is a full-time employee, or at least most of you, I'm assuming, are full-time employees. And so I want to make sure that everybody has the right program to be effective. Yeah.
Thank you.
Did I answer it? Did I answer your question? Sorry, I just started.
Yeah, talking. That's perfect. I appreciate it. Yeah, I just pinged you and I'm like, I think I'm in. So yeah, very exciting.
Dude, I love it. Awesome. All right, Toby, I think you're up.
Yeah, super good question. Can you describe or define seasoning? I'm not familiar with that term.
Oh, that's a really good question. Yeah, I guess I didn't talk about that at all. So from a high level, when you buy a home, like for instance, I'm going to go back to my $50,000 example. Okay. The $50,000 that you invest $25,000 into and it's worth 100. If you go get a loan on that property on the front end, that $50,000 property, a bank, if you were to go try and refinance that within 6 months, is going to base the value of the home based on what you purchased it at. The $50,000, not the $100,000 it's worth. Most banks need anywhere from 6 to 12 months of seasoning time from the time you first put a lien on the property. You personally put a lien on the property before they will change the valuation on the appraisal. So a couple ways around that. And I didn't talk about what's called delayed financing. This is something really interesting for anybody here who wants to do the BRRRR strategy. A couple ways around it. One, obviously the commercial loans we talked about. A lot of them don't have any seasoning requirement, like I was talking about with that one. The other way around is to potentially buy it cash. If you buy it cash, and again, you can use your HELOC to buy it cash in that situation, then there is no seasoning requirement and you can go do what's called delayed financing. There are a variety of different limitations on delayed financing, but they're only willing to loan up to 75% of the value, the new value of the home, or 100% of what you have invested, the purchase plus the rehab costs, whichever is lower of those two numbers. But in the grand scheme of things, it's a fantastic way to keep your money just cycling very quickly if you are able to buy cash. If you have any type of lien on the property, you're going to have the seasoning or go commercial. Perfect. Cool.
Hi, thank you, Nick. I guess I attended your first session. This one, the first one was really eye-opening for me, and this one I also learned a lot. So first of all, yeah, I have a question. So you discussed a lot of different strategies. So for me, I'm really just beginning my journey in investing. So I guess my question is that what was the strategy you used when you buy for example, your first rental property and your second property? And if you're given the chance to restart this process, how will you do this differently?
So the way I did my first couple of properties is I just bought using traditional financing on them. That is the cheapest money you can get. The Fannie, Freddie, 25% down. That is the cheapest, easiest money you will possibly get. And I recommend utilizing that as much as humanly possible early on, particularly when your finances aren't particularly complicated. My finances right now are crazy complicated. Like I just bought this house and I used a traditional Fannie Freddie loan. That was horrendous. Now, if I was just starting out, I would utilize that constantly. I would use it as much as humanly possible. So what I would do is I would buy as many homes cash as I could, fix them up, add incremental value, and then do that delayed financing with traditional Fannie Freddie loans, delayed financing loans. I would do that consistently. Now, what's really important is that you do this in a market where you have an incredible team. What we're talking about is hard. It takes work. And that's why I'm advocating a coaching program for people, or at least people spend a lot of time reading and getting as comfortable with this stuff as humanly possible, because doing it from a distance is hard. It takes work, it takes systems. But that's exactly what I would do if I was in your shoes. Is I would go buy as many properties as there. I would go buy the 10 properties I could using Fannie Freddie. Then I would have my wife go buy 10 properties using Fannie Freddie. And at that point, I would start going into the commercial side. But I would lock up as much cheap 30-year money as humanly possible, even if interest rates go up, guys. Everyone's predicting interest rates are going to go up 0.25, half a point. Like that is still historically ridiculously cheap money. Like we need to be capitalizing on that as much as humanly possible, particularly with inflation as high as it is. That's just free money right there, basically.
Cool. Thank you.
Yeah, absolutely. I'm going to mispronounce this for sure. Munish. I apologize. I totally just butchered that.
All good. No, actually, I think you nailed it.
Okay,
thanks.
Perfect.
Thanks, Nick. Yeah, just two questions here. Can you talk about how you structure your legal liabilities or whatever LLCs or corporations you have set up? And secondly, like, how do you manage like the tax liabilities as you go into these syndicates and do multiple deals throughout the year? We would love to get some insights on that.
Yeah, what you're going to realize about me is that I'm not that smart. Like that really, I said that a lot in my Fang to Fi conversation, and I totally mean it. I go hire people to do the things that are high risk for me, and I'm willing to overpay to get really smart people to go deal with the high risk things. And you just talked about two of the highest risk things you can possibly imagine. One is your legal liability. Three things: your insurance liability, and third is your tax liability. All of those I am not smart enough to figure out. So I've got an awesome lawyer who goes out there, and we've created a structure that I have my trust. And again, this is not legal advice, whatever the legalese that I need to say here so that you guys don't all come sue me. But I have a trust which owns then all of my LLCs underneath it. I generally try and keep about $1 million to $2 million of property in each one of those LLCs in order to essentially segregate each of them so that if something was to happen in one, it doesn't collapse the whole thing. So again, speak to your own legal professional on how to structure that appropriately. I then also have incredible insurance across each and every one of my properties, in addition to having umbrella insurance, because I am absolutely terrified of somebody slipping and falling and deciding that was my fault. So I've got that. Third question you asked is about tax. I pay, I think it's like $8,000 a year in tax prep fees. Is that a lot of money? Absolutely. Has it saved me way more than $8,000 a year in taxes? Absolutely. I hire out those things that I'm not qualified to answer and sleep really well at night.
Got it. No, thank you. That's really informative.
Yeah, absolutely. Cheney.
Hi, yeah, it's Olivier. That's my last name. Thanks for the presentation. This was really helpful. I'm curious on funding for. It sounds like it's primarily rental properties that are ready to go. Have you also looked at properties that needed substantial work before they could be rented? And which of those financing strategies would you recommend for something not necessarily either a fix and flip or more of a significant rehab prior to being able to do anything with it?
Yeah, good question. I actually think that many of these strategies are fantastic. Most of the properties that I buy are in extreme distress, let me tell you. So some of the strategies I think make a lot of sense. The HELOC strategy, being able to go and use that cash in order to fix up properties, I think that's amazing. DSCR loans doesn't fit. Seller financing could fit if somebody owns the place outright, but they own the place outright, but they can't afford to fix it up. It could be a great option for you. The BRRRR strategy is all about, essentially finding a way to finance it so that you can get that strategy. Partnership, again, I think makes a lot of sense. Lease option, I don't necessarily have a good way of making that fit. Hard money, completely designed for that. Same with private money, really designed for distressed properties. And then the commercial bridge lending that we talked about, and actually fundraising as well, I think all make a lot of sense for finding distressed properties and financing them such that you can go do this BRRRR strategy or sell it off instead. Yeah, absolutely. All right. I see one question here in the chat that I just want to answer really quickly. I think they were asking about, does the primary residence count towards your 10? Yes, it does count towards your 10. So just wanted to answer that one. All right. I've got a B here. Just a
hi.
B.
Hi,
all right. There we go. Yep.
Yeah, thank you so much for giving the talk. It's really mind-blowing. And as the first generation of immigration in the States, I feel it's a pretty struggle and it's hard for us to establish the wealth. So thank you so much for sharing. And although I have heard some seminars online, but it is really inspiring to see someone that work in the same company as me doing this and achieve their goal. So thanks.
Yeah, absolutely. I appreciate it. Yeah. I appreciate you spending your lunch chatting with me too.
Yeah, so I have a question here. You said you have hired smart people helping you find the deals, the lawyers, the tax, helping you do all the taxes, those part and the property management, those kind of things. How do you build your team? Have you met any difficult situations in doing this?
Oh boy, yeah. I have had some difficult situations. I've had some bad lawyers. I've fired 2 lawyers now because I didn't think that they were doing a good job for me. One just wasn't organized and ended up losing me about $10,000. Another was just too passive and wasn't getting what I needed to get done. So yes, I've hired and I've kissed many frogs in my time investing in real estate. It's unfortunate when that happens, but you have to roll with the punches and be willing to adjust. I've had many different property managers over the years where I've had my first one just never responded to me. My second one, and this is an emotional topic, and truthfully is one of the reasons why I'm really excited about doing a coaching program that I can help people avoid these same issues I had, stole about $150,000 from me. And never going to happen again based on changes to the business that I've had, but I still haven't seen that $150,000 back. Obviously, he's no longer my property manager, and just have had a variety of bad ones over the years. So how do I build my team effectively? I think that's a really good question. And the thing I've gotten a whole lot better at is understanding incentives and understanding how everybody thinks, and making sure that my team is all communicating and working together. My property manager and my agent are constantly in contact. I've pulled them into my Slack. My contractor is constantly being harassed by my property manager to get things done, because he's then responsible to rent the place out when it's all said. And my lawyer, he's an interesting guy now, somebody who likes to trash talk. So I don't have a good answer on why I like him. But I'll tell you, really the key in all of this is building relationships with everybody on your team. I think that's the number one piece. I go eye to eye with all these people. So my recommendation, even if you're investing from a distance, I moved out here to Indianapolis in June 2020, but I've been investing out here since 2017. My recommendation, whatever market that you're going to, go there, get eye to eye with people, and make sure that you can build that partnership with them. And the second piece of advice is, if they don't perform, be really ready to fire. There's no pit plan when it comes to your money. You better get them to understand that, you know, it's a 1, maybe 2 strike policy, but they're not getting a 3rd strike. Is my biggest recommendation.
Got it. Thanks. Seems like a lot of things we can learn in the coaching program. And another question is that last time I asked why have you ever seen other areas in the States? You said it will be more efficient as your whole team is in the same place, in the same area. So you can expand really quickly. So the question I have is that, have you considered that all your properties is in the same area? And if something happens in this area, then you will be in more risk versus you invest your properties over multiple areas, say some in Texas, some in Arizona, some in Florida, things like that. How do you see this?
I agree with you. I have a higher variability in my returns than somebody who is diversified across many properties in many different locations. With that said, I've picked a market that is the 12th largest city in the United States. Yes, it could decline, but it's not like I picked some little podunk town that, you know, hey, one employer decides to leave and everything's screwed. I picked a market that has quite a bit of diversity in its workforce. So it's super important that you look to that. And so that's the diversity I'm talking about. I work, you know, I don't think any one of us here at Meta works 40 hours a week for our job. I think we all work significantly more than that. I then have to, around my time at Meta, fit in the real estate stuff. And what I know is that if I spend an hour in real estate here in Indianapolis, I'm going to get a certain amount of return. I can go do that in Louisville. I can go do that in Texas. I can go do that in Cleveland, and I will. But right now, I don't have enough hours to justify going and investing all the time that's going to be required to get that first deal and build that first team and manage that new team in a new location, when I know I get a significant return on my time here in Indianapolis. So my answer to your question is, I absolutely will diversify in the long term, but my returns are so great here right now, I can't justify splitting my attention.
Got it. Thanks.
Yeah. So, but to be clear, I advocate people diversify. I think that's a really smart strategy. Once you have enough volume in a certain market, then it's worthwhile to move on, if you have the time to invest, to go rebuild and start from scratch again.
Thanks. I can see that in the next, let's say, 10 years, you're gonna become billionaire doing some YouTube seminar. Like I see the YouTube channels, someone called Pockets, and there are other channels that people give seminars and do the coaching.
Oh yeah, Bigger Pockets is amazing. I'll be honest with you. All the information I can teach anybody here is available on Bigger Pockets. Everything is available for free. The only thing I can provide anybody is being the filter and essentially being the guide through that process. I think all of us actually here at Meta understand information is easy. Actually getting something that's valuable, getting that news feed, getting the thing that actually we want to consume, that's the hard part. So I appreciate that. Danielle, I think you had a question there.
Yeah, I have 2 questions, and apologies if you answered this at the beginning of the presentation. I had to join late. But one, I would love to know, when you were first getting started, what capital base were you starting with? And then two, it sounds like the majority of your recommendations are applying to long-term rentals, but have you ever gone into the short-term rental real estate market, and how would that potentially change your recommendations on which creative financing strategy to pursue?
Wow, that's an interesting one. Okay, let me answer the first question, which is how much money did I come into this with? I didn't have two nickels to rub together when I started this. Like I could afford the 25% down payment on I think it was a $64,000 house. It might've been 72. It's like between 64 and $75,000 was my first house that I purchased. So I didn't have two nickels to rub together. I just bought my first primary house that my wife and I were living in. And so we were not doing well financially. We were doing well, but we just didn't have a lot of free capital to be investing. So that's the answer to your first question. Have I done short-term rentals? Yes, I absolutely have. I have two currently. I'm adding more as we go. I consider short-term rentals the cherry on top in a lot of cases. The cash flow is amazing on them, but there are so many things that could potentially screw that up that it worries me. There's regulatory risk on short-term rentals. There is the fact that hotels, nobody wanted to be in a hotel for a while. So that obviously increased the demand for short-term rentals. Will that bounce back as the pandemic continues to wane? I don't know. I personally believe mid-tier and the crappy short-term rentals, like the small ones, are probably going to end up declining in the grand scheme of things as people are willing to go back up to hotels. I could be totally off base on that one. But I think the unique properties, the bigger properties will continue to do well. So with that in mind, I am investing more in those kinds of properties here in the future, but that's not the meat of my portfolio. That is the kind of the additions. So what are some strategies that actually work for debt service coverage ratio loans or commercial loans? Actually do work for those. My current bank, if I can show, they'll do the loan based on one of two ways. If it's a new property, has no short-term rental experience, they will do it based on what it would rent for long-term and do the loan based on that. If it has a rental history of greater than a year, they'll actually do the loan based on the income of the property. If you're, for instance, buying a property that already has established short-term rental, and you're going to keep that property management in place and everything. So that's a really good option. I'm actually currently working to buy a portfolio of 6 short-term rentals that have that. So I can essentially go use a DSCR loan. I'm actually able to buy it slightly above what they would sell for on the open market because it already has the established business and the established run rate, and I'm leaving those listings in place. So really good opportunity there. Seller financing, that can work just like any other deal. I can't imagine it not working. The BRRRR strategy actually works fantastic for short-term rentals. I think that could be a big one. Really, I'm looking down the list here. Anything that where you do any value add could make a lot of sense. Hard money loans, again, very similar. You can use that to tie into the BRRRR strategy. Private money lending, again, similar thing. FHA, Fannie, and Freddie, I actually think this is a fantastic option. Go buy a house for 3% down, 5% down, and then move out and then rent it out as a long-term rental, or pardon me, short-term rental after that fact. So yeah, lots of really good options for short-term rentals. I think they're fantastic. Just go into it understanding that there is regulatory risk associated with it and potential market shift risk. So I would underwrite it such that it doesn't kill you if you have to go long-term on it. I think it's really important.
That makes a lot of sense. Thank you for sharing.
Yeah, absolutely. All right, Brianna?
Yeah, that's me. Can you hear me?
I can, yeah.
Hi, I'm in Fiji in the background. I refuse to acknowledge that outside my window. Quick question. So this has been fantastic. I think what I want to know is when you discuss markets, I'm also from, the Midwest area. And my first instinct is always to go with where first as you do expand outward. Has that been your experience, or what would you recommend? I think as a Midwesterner, you're seeing a lot of people from the coast descend and not quite understand culture, homes, and families in the cities. I'm just always so interested in that part. So if you could tell me more.
Yeah, that's a great question. I grew up in Southern California. I lived in Santa Clara when I was working at Meta in the Bay Area. So my perspective is that you should live where you want to live and invest where the numbers make sense, is my thought process. Now, there's a lot of issues like you were talking about, understanding the culture of a specific region, understanding how to integrate yourself appropriately to that region. That I don't think a lot of out-of-state investors do appropriately. So I think that there's definitely a cultural mismatch there. But with that said, the opportunities and again, I don't really care. I talked about this in my Thing to Fi presentation. I don't care what your own political leanings are. It doesn't matter. It generally makes more sense if you look at the math to invest in a red state. And just from an asset protection standpoint, it generally makes more sense. So yeah, being here in the Midwest in a pretty darn red state, it makes sense to invest here. I don't know exactly where you are, but yeah, I wouldn't necessarily assume that just because you're nearby, you can add value. I happen to move out here, but look at these walls behind me. There isn't a single picture on the wall because I have no construction knowledge at all. I literally can't even hang a picture on the wall by myself. I don't add any value because I'm here. The only value I add is because I'm able to build relationships with people. So I don't know if I answered that question. I rambled for a bit. How did I do?
I think you did good. Wonderful
Okay.
answer.
Awesome. One question here in the chat, and then I will get to Toby. By the way, is your hand still up from earlier, or is that a new question? All right, I'm going to answer the question from way here in the chat. How can you find deals in the area these days? It's become so hard and competitive. Totally in agreement. Super hard, super competitive. I have 2 full-time people that are literally looking at deals all day. That is their job, is they analyze deal for me all the time. I also, to my earlier conversation point, I build relationships. I am neighbors now, or he lives like 10 minutes away from me, from the CEO of one of the largest wholesalers here in the area. And so I regularly go and grab coffee with him. I network with the largest company all the time, the largest wholesaler. I actually just brought somebody on staff that's going to be leading direct to seller marketing for us. And he's doing cold calls constantly. Yes, it's hard. Finding a deal that's just sitting on the MLS, you're probably not going to do it. You're going to have to make a deal happen. You're going to have to go get creative to our entire conversation here. You're going to have to go find a way to make it make sense, or go and find a different deal source. Yeah, it's tough out there right now. It's super competitive. There's only 1.1 months of inventory out there on the market, and a balanced market's 3. So I think we're all looking for good properties, all looking for good yield. All right, Toby.
Sorry to drop a larger question in the last minute, but what is your thought on, it sounds like a lot of these properties that you do own or are working through now are single family. What is your thought on multifamily homes and the options there?
When you talk about multifamily, can you define what you mean by that? Like with the size that you're talking about?
So under 4 units.
I own a lot of duplexes, triplexes, and quads. I own a lot of them, but I'm not buying anymore. And the reason I'm not buying anymore is, if you buy a B-class duplex in a B-class area, generally speaking, you're going to get B minus or C plus class tenants. Because when you buy these small multifamilies, you're giving up the best of both worlds. In a single family home, you get privacy. In a large multifamily, you might get some amenities. You get a pool, you get a gym, whatever that is. But if you're living in a duplex or a triplex, you get no privacy and no amenities. So would I buy more if the deal makes sense? Yes. But I generally find that the return on my time isn't as high on those small multifamilies. Additionally, the tenant base tends to just be a little bit more of a pain in the butt. You tend to have a higher eviction rate, which again, that for anybody here who hasn't evicted somebody, I hate it. There's nothing I hate more than having to evict somebody, because I know what it does to them, and I know that they're never going to be able to probably get their lives straightened out from that point. So I try and do everything I can to avoid that in my life, because it hurts my soul. I think it can make sense. They don't tend to appreciate as well as a single family home. There are fewer buyers out there for a duplex than there would be for a single family. So for all those reasons, it's not something I'm looking to. I wouldn't avoid them if it made sense, but it's just not something that I'm personally focusing on. Hamed?
Hi, Nick. Thank you. Firstly, thank you very much for doing this very helpful and eye-opening sessions. I guess we're over time, so quickly we'll go over the questions. So can you go over the concept of wholesaling and like how it really works? So is it like an off-market property that comes to you through a wholesaler? Is that how it works? Just wanted to get...
Yeah, so wholesalers are out there, or people that call themselves wholesalers, it doesn't matter. They are out there finding a way to get a property under contract, generally speaking, when it's not sitting on the MLS. So they're out there calling people. They're looking at foreclosure records. They're looking at absentee owner records, and they're calling and just trying to make offers on properties. So for instance, I'm going to go back to a $50,000 example. In that example, I might get it for $50,000 because the wholesaler got it under contract for $40,000. And they say, hey, Nick, I have the right to buy this house at a future date at $40,000. I'll sell it to you. I'll sell that right to you for $50,000. So that's essentially all they're doing out there. They almost, this isn't 100% of the case, but in 99% of cases, wholesalers never close on the property themselves. They do what's called the double close, where they essentially close on it at the exact same moment that you close on it, so they never actually take possession.
Got it. So they're taking the spread for finding the deal. And just quickly, is it, I guess, like it's networking to find a wholesaler, or is it possible to find wholesalers like openly, I guess, in different?
Oh, there are tons of wholesalers out there. If you find a market, I guarantee there are wholesalers in that market that would love to add you to their buyers list. I get probably 100 emails a day from wholesalers here in Indianapolis. So yeah, there's networking in order to get in with the big guys and get their kind of preferred list, because I buy the deals before they ever go out to anybody else here within certain groups here in Indianapolis. So that's where the networking advantage comes in. But yeah, you can absolutely get on a lot of those lists, no problem. Now, I'll tell you, my number one piece of advice for everybody here, I'm talking about buying from wholesalers. The example I like to use is wholesalers are sharks. If you're buying with an agent, like they have to watch your back. They have to be your fiduciary. Wholesalers are sharks though, and you are a dolphin. And if you're a dolphin by yourself, a shark can kick your butt. But if you have a great team around you, you have a great contractor, a great property manager, great inspector, that's your like pot of dolphins where you can go beat the shark. But please, on your first deal, do not buy from a wholesaler. Take a worse deal on the MLS and start building your team. Because if you don't, like the wholesalers will eat you alive. They know more about real estate than you do.
Very helpful. Thank you.
Yeah, absolutely. Steve asked a question here. How do you calculate your risk and set any limits on that with all of these properties and financing mechanisms? Oh yeah, great question. I generally set my risk that I want to have at least 30% equity in all of my properties. So if things go wrong, if there's a 10% drop in the market and I decide, hey, Indianapolis isn't for me, I can still walk away, no problem. I also need to make sure that I have long-term locked up debt so that even if, again, things collapse, if things collapse 40% potentially in the market, what that means is that my property is still cash flow. So I don't have to sell. I can choose to sell whenever I want. So that's the advantage of real estate over other things, is that the kind of leverage you're able to get on the properties is extremely favorable, and they can't just come claim the property from you if there's a downturn in the market. I think we've all seen a lot of these short squeezes that have been occurring here over the last several years. So things have been a little funky in other markets, and real estate doesn't necessarily have that, unless again you're on those weird 5-1 adjustable arms or whatever people were doing back in the day. So do not recommend that. Looks like we're out of questions. I'll give it another 30 seconds here for anybody to raise their hand or unmute themselves, but I really just want to thank everybody for hopping on here. Please do reach out. I'm going to probably send an email to everybody that attended and just say thank you for hopping on, send you a link to the presentation and let you go back and review it if you want. We're going to be doing 2 more presentations here, at least over the next couple of weeks. One on how to hire virtual assistants, and the other on how to start investing in real estate long distance. If you guys want to attend those, please do. All right, I got one last question here, and then I'm going to hop off. How did you narrow down to Indiana versus other potential states? I found a market that was good enough, had good enough returns, and I did it. A lot of the people here at Facebook are going to, or Meta, pardon me, are going to struggle with good enough and making the cut. Engineers, I actually find, struggle the most with this kind of decision making. I decided I needed a market that was affordable, had a very high rent to value ratio. At that point, 1% was very feasible, not really feasible in today's market all that much, and had a very positive net migration. Once I found a market that hit all 3 of those, I dove in, I made the cut, and I went. I recommend people do the same. There's always a better market out there. There's always a better deal out there. But the opportunity cost for continuing to look is quite high. So for me, I'm sure that there could have been better things for me to invest in 5 years ago, but I'm pretty darn happy with the decision and glad I made it when I did. Thank you guys. Really appreciate all of you, and hope everyone has a great weekend.